I like to be conservative when I do my financials because I have no problem if I run my numbers and then I make more money than I thought I was gonna make, but I'll be a little bit more disappointed if I make less money than I thought I was gonna make. So I like to do my numbers accordingly. So the way I look at it is, first I take my rental income, whatever money I think I'm gonna make, and if you're working with a real estate agent, they can help you figure out what your projected rent will be. And then you want to subtract your property taxes, your insurance, your maintenance, because you're gonna have maintenance if you own a property, then your management costs because you want this to be passive, and then your vacancy because your property is probably not gonna be leased out every single month. You subtract these from this, and then you're gonna have your net income. So let's run through an example. If you wanted to buy this property that was $150,000, what would the numbers look like? So if I bought this property for $150,000, I should be able to rent it out for something like $1,400. Maybe a little bit less, maybe a little bit more depending on where you live, but let's assume $1,400. So taxes, property taxes, I like to estimate around 2% of the property price. So if we're looking at $150,000, that's $3,000 of property taxes a year, and that is right around $250 a month for property taxes. Then insurance, or a $150,000 property, something around $100 a month in your property insurance, landlord insurance. Then for maintenance, I like to be conservative and I like to estimate 10% of my gross rental income. Hopefully my maintenance is gonna be way less than that, especially if I buy a property and I renovate it. After I get the property renovated, hopefully my maintenance is gonna be close to nothing, but I wanna be conservative. So if I do 10% of that, that's $140 a month in maintenance. Management fees, I like to estimate 10% for management fees. Now I pay way less than that because I have a number of properties, and so I worked out a deal with my management company. I'm paying close to 5% in management fees, but if you're just starting off, you might be paying that 7 to 10% range. So if you want to be conservative, that's another $140 in management fees. And then vacancy, I like to estimate 1 month of rent a year in vacancy because your property might not be tenanted all 12 months of the year. Somebody might move out, and so you're gonna have a period of time where you're gonna be leasing the property out and not making any money. So if I'm not making 1 month of rent out of the year, that means that's another $116 or so that I'm not getting. So if I add these all up, I got my calculator right here, that leaves me with a net income of $654. Let me get my black marker. So $654 a month is what I'm making off of this property. Now this is assuming you bought this property with cash. I'm gonna go over what happens if you bought this property with a loan in just a second, but you're making $654 a month with just $7,848 a year, and you paid $150,000 cash to buy this home, which means you are getting right around a 5% cash on cash return a year. Now personally, this is a little bit lower than what I'm looking for, but this gives you an idea of how to run the numbers. When I look at a property, I'm looking for a minimum 7% return on my money, assuming I buy the property cash. Ideally 8%, but a minimum 7%. So maybe I'll have to get a better rent. Maybe I'll have to pay less money in management fees, which I'm already doing. Maybe I'll have to see if I can get a better deal on my insurance. Essentially, I gotta have more money every single month in order to make this deal worthwhile. But what happens if you bought this property with a loan? If you use debt, then you might be putting down 20% of the home value, $150,000. So you have to put down $30,000 cash, and then the bank is going to give you $120,000. So now you have the $654 a month that you have in profit, but you also got to pay your bank. And if you are borrowing $120,000, you might be paying your bank something like $560 a month, which leaves you with just under $100 a month every single month in profit. I think it's about $94 a month in profit, and this will bring your total return down on your $30,000 cash investment to right around 4%. So not the best return, but again, we're being pretty conservative here. You should be able to get a little bit better rent here. You shouldn't be paying this much of maintenance. So you can probably bump these numbers up in reality a couple percent, but I'm just trying to show you how the numbers work. So anytime you walk through a deal, these are the numbers you want to be looking at, and you want to make sure you do this analysis for yourself, because sometimes you're going to see sellers agents create their own pro formas to show you that you're getting this amazing return on this property that you're looking at, but they might not include vacancy, they might not include management, and they might really lowball this maintenance cost. And so all they're really showing you is your rent minus your property taxes minus your insurance, and they're ignoring this half. And so you want to make sure you're doing this pro forma yourself. That way you can get kind of a real idea of what the numbers will look like in your bank account, not just what they look like on an Excel sheet. The last thing I want to mention about the finances is this return that I'm showing you is just the return you're getting every single year on the cash that you have to invest today. This did not include property appreciation, home prices going up or real estate prices going up. That's just the icing on the cake. When you buy real estate, you want to make sure that this number makes sense for you. If this number makes sense for you and then real estate prices go up, that's even better. If real estate prices come down, oh well, at least you're still making your rental profits here. But the reason why your location matters so much is because now what you're going to see happen over the years is this top line rental number is going to go up, while at the same time your expenses aren't going to change too much. Yeah, they'll go up a little bit, but they're not going to go up as fast as the rent as long as you're in a good location. So what you're going to see happen over the years is the return that you're getting on your cash is going to increase every single year that you own the property, because you're going to see your rental prices go up with expenses not growing as fast, which is why you want to own a property in a good location. And then when it comes time to sell, the advantage here is, let's say the property value doubles to $300,000. In this instance, you put down $150,000 and you doubled your money, because now you're getting $300,000 when it comes time to sell. Here, you only put in $30,000 and then you're gonna make another $150,000 in profit on the sale price, because you only put down $30,000 and then you make another $150,000 on the appreciation of the property. If you enjoyed this short clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to start generating passive income, our team put together an amazing guide on how to start generating passive income for free. All you gotta do is click that button right over there. Thank you for watching, and as always, keep hustling.